Well, welcome everyone to our Lunch and Learn. I am Tashia McDougald. Hi, guys.
And I am Shawanda Weston from CMS Mortgage Solutions. And today we are discussing assisting divorced and separated clients. And today we're just going to talk about how we can make a tough time a little bit easier in a very sensitive situation. Um, our topics will involve describing whether or not you will buy or sell or refinance during the separation time. And we're just going to explore some of those options and clear up some of the confusion surrounding purchasing a home. Tashia? Yeah.
Sorry, guys.
Oh,
So it is a fact that clients need empathy and logical and non-emotional advocates to navigate your financial decisions successfully. You have your mortgage originator, and your realtor here to help. When it comes to divorcing and separating in real estate, you need a realtor. I'm going to speak on the realtor aspect of things, and then Shawanda is going to take over on the mortgage aspect of things. But your realtor needs to be the one that can navigate communication. Communication is the number one strongest asset that you can get from a realtor. Why? Because sometimes we have both parties that aren't really communicating well with each other. So, because you're representing the buyer and the two sellers in a situation to speak with a buyer, you need that realtor that's able to communicate with both parties, whether that is separately and duplicating communication, or whether that is together, because sometimes you have two sellers that are okay with selling the property and you're able to communicate together. Other times you have sellers that don't want to deal with each other, and they want to deal with you one-on-one. So you want your realtor that is able to communicate and have your transaction go as smoothly as possible. When it comes to negotiations, your realtor should be able to know how to handle those negotiations to ease your conversations with each other as good as possible. We'll have more Q&A at the end, guys, where you can ask questions, and we can see how we can help you better when it comes to your questions in communicating and getting the deal done and selling your home through this time. Shawanda, let them know how you would support them in this situation.
from the financial perspective, we do look at the situation as a whole, as far as your incomes, and once the division of assets takes place, what would be the best option and how we can really just get you in the home, and would you support you through that by being as gentle as possible going over the finances. And those are some of the things that we're going to talk about further in the presentation. Right, so there are a lot of unique issues surrounding purchasing a home when there is a division of assets. Or excuse me, including a division of assets, division of liability. So your assets would be whatever incomes you have, and also whatever savings and property that you own together. The division of liabilities would include any debts that you have together as well. Alimony and child support. So that would include payments that are going out in alimony or child support, or payments that are being received. So if you're the person paying out alimony or child support, then we do have to deduct those funds from your income when we get you qualified. However, if you're the person receiving the alimony or child support, those are qualifying incomes to get you pre-qualified to purchase a home. The disposition of marital home and associated debts. So when you're currently in a home and you're separating and you need to purchase separate homes, we would really look at what funds are going to which parties and how we can separate those from you and it just for you and assist you with, where the debts are going and who's responsible for what debt. Insinuating circumstances and credit, we're going to talk about that a little bit further in the presentation. Extenuating circumstances are just non-reoccurring. It's a non-reoccurring event. So of course, a separation or divorce is a situation that is it's significant, it's sudden sometimes, and we do have to be gentle with how we approach your credit and the new circumstances coming about. And then whether you're in a community property state or not. So in the state of Virginia, we are not community property. However, North Carolina and some other states are community property states. And all that means is um, any property that you own, let's say prior to marriage, so if you inherited property from your home, from your family, and then you get married at a later date, the property that you owned individually, it does become community property. So it just means that both parties have entitlement to whatever that property is. So you both have to agree on what happens there as far as the dissolution of the assets. So that's something that we'll talk about further in the presentation as well. Some of the things that we need to gather up front before we get you pre-approved are there any agreements in place? Is there a separation agreement or a divorce settlement? Whether or not we're keeping current property owned or selling it, and how will we move forward with purchasing or buying a new home? We need to know who is on the title. Most marriages and most relationships, you do have two parties on title. So that's something that we would need to know up front when we're gathering the facts before moving forward. Whether or not you are receiving financial counsel. So financial counsel, basically it would be an expert that helps you dissolve your financial issues that surround the divorce, or just help you with what money goes where. The alimony received or paid, we discussed that a little bit earlier, and that just says, it just lets us know what monies are going out when we're getting you pre-qualified, or what money is being received. Who is on the note? So with the note, it just lets us know who's responsible for paying for the loan. So in a lot of situations, you may have both parties on title, but only one party is responsible for paying the actual loan. We also need to know if you are receiving legal counsel. So do you have a lawyer that is involved, and would it be necessary for the lawyer to be involved when you're purchasing or selling your home? And then, of course, if you have children, what their ages are, and then if there's a possibility of child support being paid or received. So a lot of the agreements that are that we collect up front when we're gathering the facts are formal, that have to be considered when we're gathering the facts are, do you have a formal agreement rule in place? And basically the formal agreement rule just states that whatever agreement that you've come to in writing, or verbally, you have it in writing. So we have proof of it. We also need to know if there's a separation agreement in place or a divorce decree. The next thing that could possibly be a situation is whether or not there is court ordered or non-court ordered, whether that be child support or alimony, or if any of the funds that you currently, or assets that you currently have together, how are they being separated? So those are some of the things that we would need to make sure are either in place or that we are aware of when we are getting you pre-qualified for a mortgage. I'm gonna take a little sip here. So the next section we're going to talk about are liabilities. So your liabilities are what payments do you have? Do you have any auto loans, or is there a current mortgage in place? And if so, how many months are left on your current car payment or mortgage or even personal loans? Um, Depending on the amount of time that you have a a loan in place. So if you have an auto loan and there's less than a year left of payments, then we wouldn't need to account for those payments that are left when we get you pre-qualified. So those are things that we can deduct from your income. Um, Another thing that we would consider is whether or not you are voluntarily or required to make certain payments. So if you're separating and let's say one spouse was more responsible for the monthly bills, that is something that would be stated in either your formal and or informal agreement. And if we have it in writing, we can determine whether or not payments that are being made out need to be deducted from your income. Um, an example of that would be if the spouse has been paying the auto loans, both auto loans or auto loan for their husband or wife. If you are responsible for paying that after the separation or after the divorce, then that is something that would be possibly deducted from your income. When we're looking at credit, if let's say there's an auto loan and the auto loan is on both parties' credit report, depending on who pays it, that gives us an opportunity to know whether or not we can remove it from the current liabilities. Um, Secured debt versus non-secured debt. Secured debt would be something that is secured by a property. So whether or not that property be a home, investment property, or an automobile, those would be considered secured debts. But those are also liabilities that we take into consideration when we're getting you pre-qualified for a mortgage. Contingent liabilities. A contingent liability would be a liability that the outcome of who pays that liability may change in the future. So if you're in the middle of a separation or a divorce and there's agreements that are being put in place that may not have been completely decided, your contingent liabilities could possibly change. Also, in the regards of child support and alimony, if you haven't come to an agreement or if court proceedings are involved and we haven't decided what money is going to which party, then there is a contingency that is likely to change. Since a mortgage is based off 30 years, if you're not currently paying alimony or child support, but you will be in the future, we do have to take that into consideration. And then debts paid by others. That would go back to if you currently have a home or if you currently have a loan, automobile, personal loan, or credit cards, depending on which party is responsible for making those payments. Those are just things that we have to take into consideration when we're moving forward with getting you pre-qualified, because we don't want to put you in a situation where you qualify for the mortgage or the loan now, but once you have to have funds paid out of your income, or once you lose a certain amount of income, you're unable to afford your home. And then a quit claim deed would be a transfer of ownership. In a lot of situations, one spouse may stay in the home and the other one may move. So you can transfer that property to the spouse or to your partner without having any type of warranty of title. And we just talked about different extenuating circumstances. So an extenuating circumstance would be a sudden or significant change. So we did discuss that. Manual versus automated underwriting. And Depending on your situation, if you're separating or divorcing and income isn't an issue for either party, then typically you would be approved by automated underwriting. However, sometimes when things get a little bit challenging as far as what goes where, who's responsible for what, we will do a manual underwriting where we will send up your file to an underwriter and we'll give them the details and all the facts that we gather so that they can make a informed decision to make sure that we're pre-qualifying you for the right amount, because ultimately we don't want to put you in a position where you can't afford your home. The different options, conventional financing versus government loan. And that would just be whether or not conventional would be the best option for you. Government loans are FHA, VA, and USDA. And what we do is we look at your specific situation and we'll help you determine which loan best suits your needs. So just a few quick tips. Like we discussed a moment ago, we will look at your specific situation and determine what would be best for your situation. So FHA and VA loan programs, which are government funded programs, if you have documented receipts of child support or alimony and it's less than 6 months, then FHA and VA, those would most likely be the best program for you. Child support, if it's voluntary. So if you've decided that in the separation or divorce that you've come to an agreement that isn't court ordered, and although we have to consider that amount, even if it's not mandatory, FHA would likely be the best program for you, or that would be a program that could benefit you most. But ultimately, we do have to look at the entire situation to decide which route we need to go. Whether or not we need to gross up child support or qualifying income. In this circumstance, if you are the person receiving the child support or the alimony, well, not the alimony, but if you're the person receiving the child support, we will gross up that income by 25%. It puts you in a higher tax rate. Typically, child support, well, usually child support is not taxed. So we are able to gross that amount up so that if you're the person receiving it, you do qualify for a little bit more, excluding what taxes would be typically taken out. And then title, whether or not title has been transferred. So that goes back to the quitclaim deed. If the title has not been transferred from one party to the other, or if one person has not come off a loan, then Freddie Mac would be the best program for us to move forward with. And then a circumstance that includes whether or not it is an extenuating circumstance. And if you need flexibility, then Fannie Mae would be the best option. All right. Well, of course, my name is Shawanda Weston, and we're just going to we're going to have my personal information on the screen as well as Tashia's. So if you want to get in contact with us and if you have any questions about anything regarding, if your income has changed or if you have separated or if you know in the future that you're going to need some assistance, then definitely reach out to us. But if anyone has any questions.
So I think a question that I hear often is, what do you do if you own multiple properties? Do you have to do the same process over and over again?
Do you mean in regards to whether or not the properties are being sold or?
Yeah, so say if a couple owns more than one home, like a regular house and a vacation house, do they have to do both of those separately?
They do have to do them separately in regards to if they're refinancing the properties or if they're selling them. However, if a couple, that would really narrow down to the agreement, whether they have an informal agreement, whether they've come to a decision with the separation. If they decide that one person will take the primary residence and the other person will take the investment property, then at that point, we would just refinance the both of them and determine what income or what payment is going to which person. And we'll look at their income to see if they qualify for it on their own. But usually, that's when the financial counsel and legal counsel comes into play, because we want to make sure that we're able to come to an informed agreement and everyone's happy as possible, rather.
All right, perfect.
Yeah.
Well, if anyone doesn't have any additional questions, you can get more resources at cmsmortgage.com, as well as follow us on social. And Sashia, I know your social isn't on here, but if you would like to drop your handle for everyone.
Yes, it's at Asktashiya, ASKTASHEA,
And her,
on IG and Facebook.
yes, her pages look fabulous. I did a little cyber stalking, so.
Thank you.
Yes.
Very welcome. Well, thank you.
Thank you, everyone.